Hello. Welcome to the not quite quarter end CML Pro webinar, which will talk about the market. So when we do the CML Pro webinar, we can just talk about stocks. I think this is a better way to go. Hope everyone is having a good Thursday. And if you're not, I hope you have a good Friday. I'm speaking slowly because people tend to join at the very last second. And I will begin now. First, some disclaimers. This is not a solicitation to buy or sell any security ever. In fact, this is not advice. The results here are provided for general information purposes as a convenience to you, the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. This is the agenda. We have just finished the agenda slide. Well done. I will do an economic update, short-ish. I'll do what a bear market looks like, short-ish, and then we'll do Q&A. If you are here for this webinar, I urge you to either decide now that you will stay to the end of the presentation, which is not long. This is not a CML Pro webinar length. This is 30 minutes max, because I would not stop in the middle. Although it will feel like it's colloquial, it's actually like a 150-page memorized soliloquy. So I urge you, having written it, not to start unless you're going to finish, because there is going to be recording. So if you don't have half an hour, you can always just watch the recording. All right, economic update. It will be short-ish. Before I start, this is not a statement of political belief. Nobody cares what my political beliefs are. I'm not sure I care what my political beliefs are. I have been accused of being a libertarian, of being a crazy left-winger, of being a crazy right-winger. I've been accused of being a Trumper. This may surprise all of you. I'm none of those things. So if you can figure out my political affiliation after having given you that, then good luck. But I assure you, I'm none of those things. All right. This is where you will do yourself some good, if you're here to hear this, to remove your political bias so that you can do what's best for you and your family with regard to money as it is invested in the stock market, not with what you can do best for your family as it is in regard to your church or your synagogue or your mosque or your neighborhood or your backyard or for dinner or for barbecue. I am here to talk about what I think is best for your investments that are in the stock market. That's all. That's what I'm here for. If you want to hear my opinions about other things, we can do that later. But I wouldn't hold a webinar for that because that's not fair. I used to say that COVID was the irritant, and it was. The irritant from COVID is over. It's over. That's good. I will start with a happy bullet point. I believe we are after this. I said when we're after this, blah, 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 we are here. We are not a little before after this. We might even be after this. But we did it. We made it. I am not concerned about inflation. I know others are. Not my concern. And if we do have inflation, it's not because of COVID. And it's not because of fiscal spending. So we did it. I believe after this could have looked something like this. Something like this. Where we got a jobs report that really freaked people out. The Fed was like, oh, we really fucked up. We should have cut rates. The Fed did cut rates. We had an election, and after this was around here, and It was going to have some tops, but each high was going to be a new higher high. It was going to be glorious. It was this. That was after this. When everyone realized after the jobs report the Fed was late, the Fed became not late. We had an election. We were after this. It was a glorious, glorious 6 months. That is after this. And then we have a new irritant, and it is tariffs and stuff. And that's what this looks like. So I hope you enjoyed after this. It was really short, about 5 years shorter than I thought it would be. And this is where we are now. You're welcome. I do not think. Oh, yeah, I believe after this would have looked like this. None of it matters anymore. I do not think what we're experiencing now is short term. I do believe this is appropriate. I think the sell off is appropriate. I think if it is what it seems like it should be, I think we should be much, much lower. That's what I believe. I wrote that in a dossier earlier. I don't think S&P 5,500 is fair value given what's happening. I would be more like an S&P 4,000. Here's some data. Manufacturing prices paid are rising. They're at the highest level since June 2022, when we were at the peak of inflation. We're now there again. And it's largely driven by impact of tariffs. That is not an opinion. This is from the ISM report, where managers, the Institute of Supply Management managers, tell us, why do you think prices paid are going up? And they list the reasons. Tariffs are the number one reason. So it's not an opinion. Well, it's their opinion. It's not Ophir's opinion. This is just a matter of fact. This is what they said. While manufacturing prices paid are rising, so are services pricing, which is a problem. Because that's the whole economy, manufacturing and services. Sometimes they call it manufacturing and non-manufacturing. Third consecutive reading above 60 on a scale of it's called a diffusion index, where above 50 is expanding, below 50 is contracting. It's the first time we've had 3 in a row since March 2023. So both of those are expanding. But in the meantime, new orders are falling. They're now in contraction, and they fell the most since March 2022, which was when people thought we were in a recession. Prices at peak inflation highs, services pricing rising, orders now in trough of economy. Manufacturing employment is falling. It's in contraction. And this is relative to where it was a month ago, a month before then, and a month before then, and a month before then, a month before then, a month before then. It's in contraction. Okay, so I'm just going to kind of tighten this up and keep going. So new orders are falling, employment is falling, production has slowed sharply. Okay? Whatever it is that people think is happening in the manufacturing sector, they believe we are going into a recession. They have slowed production, and they are seeing slower orders. They are hiring less while prices are rising. These are the facts, and they are not disputed. Consumer inflation expectations, as measured by the University of Michigan 5-year inflation expectation, is now at a 30-year high. They are higher now than they were at peak inflation in 2022, when CPI was 9.1%. US business optimism has dropped. This is it's now 59% of respondents cite tariffs as a negative impact. So again, I'm not saying tariffs are the problem. Businesses are saying tariffs are the problem. Manufacturers are saying tariffs are the problem. US executive confidence has dropped to 47% from 67% December. In December, with kind of the promise of a new administration, executive confidence was surging. Still, oddly, 67% is high. It's not as high as it's ever been. But still, we'll take 2/3 of executives being confident. They're now down to 47%. So that is in 3 months. Okay, I'm just going to pinch everything together. The NFIB, so those are large businesses. NFIB business sentiment, this is for small businesses. This is the National Federation of Independent Businesses, okay, NFIB. The NFIB index is a composite of 10 seasonally adjusted components calculated based on the answers of around 620 NFIB answers. So they asked these 620 people questions, all part of this small business group or independent business group, and they answer the questions. The questions in this that they ask is like, what are these 10 questions? Or 10 components. It's employment, capital outlays, inventories, economic expectations, real sales, inventory, job openings, credit conditions, whether it's a good time to spend or to expand, and earnings trends. That's what they ask them. Expectations for better conditions in the next 6 months, so from now to 6 months, have dropped. So their people are expecting worse. There is a decrease in the number seen now as a good time to expand. That means that while we have larger manufacturing saying that orders are falling, employment is falling, production is slowing, prices are rising, the small businesses are also saying the next 6 months things look worse. There's a decrease in the number of them saying it's a good time to expand right now. And as you know, with small businesses, if they're not expanding, they're shrinking. They ask these people too, okay, like when they ask the question why, and inflation remains a significant concern. It was not the number one concern. You can guess what was. Finding and retaining skilled workers became the primary challenge. That's now the thing that's hard. Okay. All right. But the labor market is okay. I know the last non-farm payrolls report and ADP reports were below consensus estimates. No doubt about that. I still got to tell you, while I'm here to deliver some bad news, I'm not going to overdo it. I did not think the non-farm payrolls report was bad. I just didn't. I really didn't. It wasn't like, oh my God, good, but gun to head, someone says, you got to tell me, is it good or bad? I would have said good. I would have said good. I'm going to use the word okay because I don't have a gun to my head. So, okay. I'm not going to pile it on. Labor market's okay. I think you can make an argument the labor market is strong. Okay. The president of the United States said this, and I do quote, there will be a little disturbance, but we're okay with that. It won't be much. It may be a little bit of an adjustment period. The Secretary of the Treasury, could we be seeing that this economy that we inherited is starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. That statement, a natural adjustment as we move away from public spending to private spending, is total and utter horseshit. I don't think the president of the United States said anything that was horseshit. Besant did, and I'm going to show you why in a second. He's trying to pass the buck that this is because of government reining in spending. The government has not reined in spending. Not yet. And if the government reins in spending, which I think it will, we could have another leg down. But that is not this leg down. And don't worry, I will prove that to you in chapter and verse. This is the Secretary of Treasury, again, not the president. Access to cheap goods isn't the essence of the American dream. He says the market and the economy have become hooked, become addicted to excessive government spending, and there's just going to be a detox period. There will be a detox period when government spending comes down. Probably. But we wouldn't know yet because that hasn't happened yet. A continuing resolution was just passed in the House. We don't even have a budget yet. So the Secretary of the Treasury Secretary, is bullshitting you. I think he's super smart. This is bullshit. Or if you prefer, I find the last statement concerning. Well, why? Every piece of data discussed above references tariffs, not fiscal spending. Let's see if that's true. All of this, everyone asked, they said it was tariffs. Every single data point. This is about excessive tariffs. What is excessive? I don't know. How can I tell you? That's what they're saying. It's about excessive tariffs. We can't say it's about tariffs because we've had tariffs for 7 years or longer. So we can't just say it's about tariffs. It's got to be excessive tariffs. The Trump tariffs put in place in his first term were carried through by the Biden administration, which means this is going to scare people. There was actually bipartisanship. I know no one would ever say they agreed, but if Trump put them on and Biden left them on because they were executive orders, they were not passed as laws, then there was bipartisanship. So both parties thought we needed some tariffs, and the market did just fine. Actually, the market's spectacular. So this is about excessive tariffs. We can't say it's about tariffs because tariffs have been around for a while and people were good. Tariffs can and are and were used to pressure nations like China or Mexico to negotiate. Excessive tariffs cause all of this stuff that I just showed you. And while we're at it, Scott Bessent telling us what the American dream is. Free trade lowers costs and raises living standards, and that is the American dream. That you are born in one place financially, and that you can raise yourself several stations simply because you work hard and you happen to be blessed to be born in America. That is the American dream. Scott Bessent is mistaken. And how do I know that this is from inflation? Sorry, pardon me, from tariffs. I'm just going to give you headlines. Now, this doesn't mean I think the headlines are right or wrong. What I'm telling you is what is driving sentiment, okay? So remove whether you agree with these headlines and just understand that these are the headlines. These are all CNBC, Reuters, or Bloomberg. Those are the other ones. Wall Street left dazed and confused as Trump jolts markets again. That's because of tariffs. President Trump's trade spat with Canada, blah, 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 sell-off. Trade spat's code word for tariffs. CNBC Daily, tariff fears wipe off election gains. Tariffs break trust. Tariffs come into force. Businesses sound alarm as Trump tariff chaos hits the economy. Tariffs are a lose-lose. Trump threatens then reverses new Canadian tariffs. Trump is unleashing sweeping new import tariffs. The Dow dropped, this is today, Dow drops 400 points, correction territory as Trump threatens more tariffs. This is today, 4 hours later. S&P closes in correction territory as stocks tumble again on tariffs. 95% of economists polled by Reuters last week across Canada, Mexico, and the United States said recession risks in their economies had increased as a result of tariffs. I don't think we're going into recession, actually. I think the labor market is strong. This is because of tariffs. This is not because of the Trump administration reining in fiscal spending. The Trump administration might rein in fiscal spending. That was a campaign promise. And that could cause some short-term pain, possibly. This ain't it. And the reason it's important you know this ain't it is because if that comes, it's going to hit us again. This is because of tariffs. This is about tariffs. A reminder on April 2nd. April 2nd. That's what Letnick told us, right? There's going to be the tariffs on the tariffs for the tariffs. And my opinion is this. If this is tariffs for the long term, quote, unquote, rather than strategic for negotiating, right? Strategic for negotiating is what we saw with Trump in the first Trump administration, which Biden actually went along with, which means Trump was right? Because that was an executive order. Biden could have said, no, those are stupid. Nah, no, he didn't. He actually raised tariffs a little. So if it's tariffs for the long term, I think we could go 30% lower on the indices and 75% lower in tech stock names. So for example, I think Tesla could go to 50. This is because of tariffs, not fiscal spending. It's very important that you know that because the fiscal spending cut is coming. I believe that the Trump administration is, I don't think Doge is actually doing anything, but I believe just formally speaking, like I believe the Trump administration is going to look to squeeze fiscal spending, which I think the U.S. needs. It doesn't matter what I think. So, but this is not because of that. And actually, there's more, but I'll get to that in a second. So, what I think, and it's just what I think. I don't know. You don't have to think so. That's just what I think. Economies, even the magnificent ones like the United States, the glorified ideal, shall I say, that is the United States, they're oddly fragile. We all know this from just 2 years ago. It's like a single mind or a shared mind. I don't know how you like to say it. It kind of permeates all economies. There's this single mind that goes across, right? We just felt this with inflation. It's just like everybody felt the inflation. And that means that this single mind or shared mind, what it really means is that sentiment drives the economy. If we believe prices will go up, we will buy things now rather than later. Because if it's going to be $110 next week and it's $100 today, I might as well buy it today for $100. Well, what happens then? Well, that increases demand and then prices go up. Japan had the exact opposite. Japan, for 40 years, had deflation. So if you wanted to buy the TV today for $100, you might as well wait till next month because it'll be 90. And if you're going to buy it next month at 90, you might as well the month after that because it'll be 80. That sentiment kept the Japanese economy in deflation. It's really just sentiment. It's very, very fragile. The way I read it is that volatile sentiment from the market, and that's what I'm reading, and the economic surveys, we have volatile sentiment from the market and economic surveys unambiguously. There is no doubt in my mind, doesn't mean there isn't a doubt in your mind, that the market reads volatility. That we don't really know as a market, we being the market, speaking as the voice of the market, we don't know what's going on with tariffs. I read a leadership that has an agenda. The Trump administration has an agenda. The Trump administration has been clear about their agenda since before they became this, what they call Trump 2.0. In fact, I would go so far to say, as there has not been a presidential campaign that was as clear about their agenda as the Trump campaign this time in my lifetime. In my lifetime. You want to talk about not being political? He was like, this is what I want to do. And it continues to be clear since taking power. I will say, now Scott Bessent's little misdirection, okay, he can go fuck himself. That was bullshit. This is about tariffs. Trump talked about tariffs. There will be a tightening of fiscal spending, I think. I don't know. That's what Trump said. Then we can talk about that too. Okay, but that's not now. The headlines from Doge are they're just headlines. Nothing's actually happening. They failed at almost everything they've tried. So far, no, I'm not. I do think the Trump administration will rein in fiscal spending. However that looks, I don't know. How about this? I think they'll try. Whether they'll succeed, I don't know. Okay, so just forget that thing about how the economy is hooked on fiscal spending. It might be, but we haven't gotten off of it. If the economy is a person and fiscal spending is cocaine, the person is still doing lines of coke every day. We're talking about going into rehab, but we haven't. We're still on coke every day. Okay, so just stop it. Don't tell me I feel like shit because I'm getting off the coke. I'm not going to get off the coke for like 6 months. Someone's going to cut that up and put it on YouTube. To me, this means the stock market is less valuable. It just does. The stock market is less valuable to me right now. That's it. It might be long-term tariffs makes the stock market less valuable to me. I said it might be long-term tariffs. I didn't say it is long-term tariffs, but the fact that it might be means there's more downside risk than I previously thought. I don't think there's more upside potential. I think the upside potential is gigantic. I I thought that for a while, but now I see more downside risk. So the market's worth less to me. That's just the truth. And why? Why, to me, does this mean the stock market is less valuable? Why? Well, I told you there was more data. So here's Q4 that ends December 31st. Okay. Earnings were about 7.5% above consensus estimates. This is the S&P 500. I should have said that in the slide. When I say earnings, I mean S&P 500 companies. You're like, is that good, bad, nothing? 5-year average is 8.5%. 10-year average is 6.7%. It's kind of right down the middle. Q4 was fine. Q4 was fine. Earnings were good. Earnings were good. The beat rate, so it's like, okay, the earnings came in and then they gave guidance. Right? Approximately 77% of S&P 500 companies beat their Q4. Oh, sorry, no, not guidance. This is for the quarter. Yeah. About 77% beat their estimates. 5-year average 77%, 10-year average 75%. The beat rate was normal. The magnitude of beats were normal, 7.5% between 6.7 and 8.5. Like Q4 was fine. It was fine. Market was it was just fine. So why is the market going down so much, even though we had that? This is why the market's going down so much. And this is why the market is less valuable. Consensus was 7.3% year-over-year earnings growth for Q1 2025. That's what it is now. It's down from 11.6%. That is a cataclysmic drop. In one quarter, 2025 went from 11.6% growth to now the consensus is 7.3. That is cataclysmic. That is a huge number. And since December 2024, just since December, estimates have dropped 3.7% versus 3.3 on the 5-year average and 3.2% on a 10-year average. It has hit us just now, just until just boom. This is why the market is less valuable to me. This is tariffs, not fiscal spending. I'm not saying there won't be a change to fiscal spending. I'm saying there has not been, and this is not it. You should know that because if you're afraid of a fiscal spending slowdown, we're going to have that too. And if you're waiting for fiscal spending to slow down, well, then we haven't had it yet. To me, this means the stock market is less valuable. This, excessive tariffs, means the stock market is less valuable. I want to participate less in the stock market. That's a fancy way of saying I see the same upside, which is really good. But now I see more downside. Since the outcome continuum has shifted to the downside, I want less of it. Do you remember when I told you when I started the webinar, I said, if you're going to start this webinar, make sure that you finish this webinar. Don't stop in the middle. And that's because of what I'm going to say next. I want less of it. Unless tariffs get settled, are not excessive, and are not long-term. I think the stock market is less valuable unless tariffs get settled, are not excessive, and are not long-term. This is why I didn't want you to start the webinar and leave 10 minutes in, because you would have missed this slide. This is how I see the world. This is fact. This is why I think the market is less valuable, unless tariffs get settled, are not excessive, and are not long-term. The excessive part is the big part. We have had and continue to have tariffs across 2 administrations who could not see the world more different. You know what they did agree on? Tariffs. All right. What does a bear market look like? Well, bear markets, even if they're short-lived, all kind of look the same in a few ways. Most notably, earnings results a week later. So earnings results happen. Then you look at the stock a week later. They're either bad or very bad. Those are your choices. That's a bear market. Example is Cloudflare. I made sure not to choose a top pick because people are going to get, whatever. So Cloudflare. This is what Cloudflare looked like. This little green circle down here, that's when earnings came out and the stock went, right? Big. Whoa, huge. Great earnings. But this is what it looks like when we're in a bear market. That's what happens 2 weeks later. That's where they were pre-earnings. All of that's gone, and then they're way lower. Okay? This is what it looks like we're in a bear market. It's like, yeah, oh shit. This net, take out all the spiking, earnings happened. 2 weeks later, the stock was there. That's what it looks like in a bear market. And that, other examples are like Confluent, DigitalOcean, Elastic, GitLab, and Zscaler. And that's the bad. The very bad is like Trade Desk and Global-e. The bad is the best you can hope for. It's Cloudflare, Confluent, DigitalOcean, Elastic, GitLab, Zscaler. That's the best you can hope for. It's bad. The very bad is those two and many others. But remember when I told you when you start the webinar, make sure you finish it. Right? I said if you're going to start this webinar, make sure you don't stop in the middle. Because of this. It's another but. But this is also what a correction looks like. Bear markets and corrections look the same at the beginning. They look exactly the same. What's the difference? A bear market is deeper and longer. What would be deeper and longer? If excessive tariffs are long-term. You want to know if we're going into a bear market? Then you tell me if tariffs are excessive and long-term. If they are, we are. If not, this is just a correction. That's the choice. You have choice A and you have choice B. That's it. That's it. Remember? I said the stock market's less valuable to me. Less tariffs are not excessive. They're not being thrown around like baby food, and tariffs get settled. Just like the difference between a bear market and a correction. I don't know any better way to tell you how I feel, why I feel that way, and what the implications are of how I feel as it pertains to the stock market and whether it's in a correction or a bear market than what I just did now. That doesn't mean I did well. It just means that in 33 minutes, that's the best I could have done. This is Ophir's best. That does not mean it's the best you will hear. It doesn't mean that you couldn't do better. This is what I could do.